This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
I want to jump into your Postgame chart deck, which is titled, What is in Store for the New Year? Let's get into the charts and talk about how some of Jesse's views translate to the markets. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered. Just go to macrovoices.com, click the red button on the homepage that says Looking for the Downloads. Patrick, let's jump into page 2, S&P 500. Boy, look at that change in trajectory going back to the beginning of 2020. Nothing like a global pandemic to really ignite upside in the stock market.
Right. I mean, almost every week we put up a chart of the S&P 500 using daily charts, which only usually captures a year of data. And I felt when listening to Jesse's interview and him highlighting a lot of the conditions that make this market so incredibly overbought and overdue for a correction, I thought zooming out and really putting this chart into perspective over the last 10, 15 years is really important. I mean, we go back to the 2009 market bottom and we just look at the bull market that has ensued, and it was quite the bull market, but really there has been an extraordinary acceleration of trend in the post-pandemic period, and this has really just had this huge rip to the upside that has made this almost exponential rise in these markets. And the question really here is, okay, if the markets are so overvalued and you have a scenario where potential returns are going to, in the future, be less just simply because of these high valuations. The question is it simply a fact that the market will suddenly start to be trade range bound after such an extraordinary move? Or will, when we had Julian Brigden come on and others talk about the fact that we're overdue for some sort of a correction? Now, when we look on the daily charts on page 3, we clearly have a market that looks like it's actually bullishly going to break out. Right now, there's no technical reason to actually believe that this that kind of scary bearish breakdown is imminent. And wouldn't it be interesting if the way this kind of played out was the market ends the year and starts the beginning of the new year with a big push towards 4,900 and 5,000 on the S&P. Everyone just goes all in, and then somewhere in the latter part of the first quarter, potentially a correction comes in. The point I'm trying to highlight is that while certainly we can make a lot of bear cases for the market, on the short-term technicals, there's not a lot of reason to believe that this is imminent.
Patrick, the nominal price of the S&P 500 has more than doubled since the March 2020 lows. That's not because global pandemics are good for the economy. It's because central bank stimulus is good for asset markets. So the big question is the Fed serious when they say that they're going to taper and they don't have the markets back and, don't count on us to bail out the stock market. That's not our job. We're here for the real economy. I don't believe that. I think that what's most likely to happen is this market continues to melt up until we get the beginnings, maybe, of a crash. And that's when the Fed is going to change their tune. Now, if they actually say what they mean and mean what they say, then we got a big crash coming ahead of us. But by the time it gets going, I think they're going to change their tune. In any event, Patrick, let's move on to page 4 and the Volatility Index, or the VIX. Seems like this latest vol spike is basically retracing out of the market.
Right. It's interesting. There's a lot of work out there by those that analyze volatility. And whenever you get a VIX that spikes above the 30 level, it usually marks one of two things: the beginning of some sort of a left tail market correction that is of serious magnitude, but more often than not, it marks a tradable low that creates a subsequent rally that could be anywhere in the 5 to 10% variety in the following 20 days. So when the VIX got up there, it was really an interesting moment to see whether it proved to be that buy on dip, which at this stage, it really does look like it's the case. As the volatility heads down to the bottom end of its ranges, that adds like a tailwind to the markets and may actually continue to be, on the short term, some further fuel to actually drive a new high on the S&P. And this is goes back to that same narrative that we sort of talked about. Maybe on the very short term, the market is likely going higher, and all of those kind of scenarios of a bigger or deeper market correction that Julian Brigden and company have been talking about may be in store, but maybe it's something in the latter part of Q1 that could materialize. So moving on, Eric, I want to touch on page 5 here, the light crude oil futures. And what we can see is the December swing high that we had after that drop in prices is now being exceeded. And crude oil looks like it may actually want to head up back to the to mid to high 70s. Maybe we might even see an $80 print. Certainly feels that way. Obviously, you were highlighting some short-term volatility risks over the holidays, and that's certainly something we'd have to take into account. Nonetheless, Erica, what's your thoughts on this chart?
Well, Patrick, this chart looks really good to me. If anything, I would be adding to my long position here if I were trading just on technicals in the chart, because we've got a very clear pattern. It looks like we put a bottom in. We've now got a series of both higher highs and higher lows. Everything's looking great about this chart. Why did I de-risk substantially in the last several days? Because I think that big, scary headlines are coming. I think the market is smart enough to know better and realize Omicron is more of a red herring and a nothing burger, because it's going to be off the charts in terms of cases. Everybody on the planet is going to get this thing. Frankly, I'm looking forward to contracting it myself so I can get it over with, because I know that it's coming, not just for me, but for everybody else. That headline could come during low volume, thin liquidity holiday trading hours. And if it does, it could crash the market down to $50. It's not that I predict that that's happening. I think the more likely case is the market keeps moving up and I end up missing out on some of the upside. But you know what? I think there's a whole lot more upside to come after that. And I just don't want to be super exposed during this holiday period. Could go the other way, and what happens is we get good news during the holidays and that thin liquidity takes us back over $80, and boy, I guess I really missed the boat. But let's move on to page 6, because we had a listener question about backwardation and why it exists in the crude oil term structure. Page 6 is showing us what's called a term structure chart. The leftmost yellow dot at the top left of that graph, right around $73, that's the January 2022 delivery contract for West Texas Intermediate crude oil. Each subsequent dot to the right of that going down is 1 month later. So the question to ask is, how do we interpret this? What message is it giving us when each subsequent contract costs less than the one before it? Now, the answer here is almost everybody, including professional futures traders, make the same mistake. The way they interpret the market until they learn how this really works, especially in crude oil, is they say, boy, the market seems to be predicting that prices are going to be lower in the future. Because right now, if you want to buy those futures contracts that are out into 2027, they're down there at $57, $58 as opposed to $73 to buy the current contract. So it seems as though, visually, just looking at this chart, that means the market is predicting that prices are headed lower. And that seems very much at odds with what I've said and a lot of other people have said about the lack of investment in new production, really leading to explosively higher prices in coming years. Well, believe it or not, that is what backwardation indicates. You would sort of think the opposite, because it seems like if the price is going to go up, you'd think the market would be in contango, where each subsequent month has a higher price. The thing is, contango basically creates a financial incentive for oil companies to leave oil in the ground, because they can get paid more by selling future-dated contracts than they can get by selling today's contracts. So there has to be some degree of backwardation to incentivize the oil producers to take the oil out of the ground. So believe it or not, the way this works is that when you see backwardation, the way to interpret it is the market's willing to pay a premium to get oil right now because we're afraid it's going to get more scarce and we want it now while we can lock in the price. That's what backwardation means. So when you look a year out on the chart and we see that, between, August of 23 and September of 23, still in backwardation there. What that means is the futures market is predicting that the physical market is going to stay tight all the way through that period. So backwardation actually is an indication of a tightening market, and it generally is bullish. It means prices are likely headed higher. Well, wait a minute. Something doesn't add up here. If prices are headed higher, and that's what this chart is telling us, doesn't that mean that there's an inefficiency here, which is the chart's saying it's predicting prices to go higher, but if I'm willing to buy a contract that's dated a year out, I can actually buy that at a deeply discounted price? Kind of doesn't make sense. Well, I agree. It doesn't really intuitively make sense, but that's how it works. And yes, you do have that opportunity. Well, isn't that a free lunch? How could it possibly be that way? The answer is when you buy that contract that's a year out, you're getting a big discount, but you're also missing the roll premium that comes from rolling that contract forward every single month. So particularly in the Brent term structure, which is not shown here, you usually have the most backwardation at the very front of the curve. You're better off to just get the front month and roll it forward. With the WTI strip, I think you're better off to buy a little bit further out on the curve. I like the June and September of 22 contracts much better than the front month if you want to buy the recovery of the WTI contract. And the reason I say that is that the storage in Cushing, Oklahoma, is that rebuilds will eventually take some of that backwardation out of the very front of the curve. So that's a quick overview of how backwardation works, and it is exactly opposite of what you would expect in many ways. Let's move on to gold futures on page 7. Patrick, what do we see here?
Well, Eric, what I just wanted to highlight, when we talk about where those moving averages near the 1800 level are on gold and where are some of the key hurdles to beat, but what I wanted to do was put a volume profile chart up to show where the vast majority of buyers and sellers were transacting on a volume by price basis. And what you can observe is that we have a substantial consolidation right where we're trading. In this 1780 to 1810 area has a large amount of these high volume nodes. And to me, as we get above these moving averages and above these high volume nodes, that would be the first bullish constructive price action we would see in gold. And you can see that if gold was to get above the previous high around 1860, 1870, you would really start to open it up. And right now, I'd like to say that it's best to take a neutral approach to gold and let gold's price action do all the talking, because right here we're right at a very critical pivot, and if gold is going to be bullish, it should start to show constructive breakouts out of these zones, which would be the first indication that maybe it's happening right here, right now.
Patrick, in the next few charts, we've got the grains. Why grains, and what do you see in these charts?
Well, Eric, wheat has been relatively bullish throughout the second half of this year, but one of the things that's bothered me is that it was not being confirmed by any sign of any bullishness on corn or the beans. And what we finally are seeing is a wheat chart that is turning up, but finally corn and soybean look like they have bottomed and are starting to constructively move higher. And this is something that I think is worth watching, because when you have all of them bulling together, sometimes when some of the best ag moves occur, you're seeing new breakouts in stocks like Nutrien and stocks like Mosaic turning up. It'll be interesting to see whether the ag story comes to life here.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Patrick's service, Big Picture Trading. Information is available on page 11 and 12 or bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.